Hi, so I'm going to do a quick whiz through where we currently stand with US equities and US government bonds in terms of the market and valuations. We've had a very strong start to the year on the equity side, and so already we're hearing people say, with respect to stock market valuations, equity markets are expensive, but that is not necessarily true for all of them. And indeed, as we often say, it's a market of stocks rather than a stock market. But at the overall stock market level, I guess, yes, you could say that on a backward looking 10-year basis, US stock indices are not cheap. So, for example, the NASDAQ is trading at 25 times forward earnings. If you look at the 12-month forward PE ratio today of 25 times compared to the average over the last 10 years, then that puts it up in the 83rd most expensive valuation percentile. And for context, the S&P 500 is up in the 86th percentile. But even in the US, you can still find relatively cheap sectors which have been very much out of favour last year and continuing to this year. So, for example, energy, small cap value, and stuff like utilities and staples are on the other side of that trade. So there are some relatively cheap sectors, and I say relatively cheap. The first 2 weeks of the year, however, we've actually seen defensive sectors outperforming cyclical or commodity-driven sectors, and I guess the reasons for that are fairly obvious. So if we assume that earnings growth at the overall level is going to be at between 0 and 5%, let's say, it's fair to say, is it actually fair to say that the S&P 500 is expensive at 4,800, which is around the current level? So one way of doing this is if we deconstruct the S&P level of 4,800 into a 12-month forward earnings looking and a 12-month forward looking valuation, let's assume that the EPS at the index level for this year is $225, which is assuming, a pretty anemic growth rate of 3 to 4% against, from the bottom up, analysts still expecting over 10%, then actually that puts the S&P on a forward PE ratio of about 21 times, which is the equivalent to an earnings yield of about 4.75%. Now, what does that really mean? Where does that sit? Well, equities always should pay a risk premium to be held in real terms over the risk-free rate or over US Treasuries, meaning that the real expected return of equities should always be higher than the risk-free real yield that we can get from holding US Treasury bonds. Now, the multi-decade average real return delivered by global equity markets is cash plus 4.5%. And given that the S&P is a market cap weighted index, and therefore you have heavy weighting of companies with huge pricing power, so think in terms of mega cap tech, then because these companies have got pricing power and therefore can increase their price at least at inflation, you can almost think of that 4.75% earnings yield as a real return. So in which case, the S&P 500 at 4,800, which is approximately where it is, would be fairly priced. Now, what am I assuming there? Well, let's just assume that earnings do disappoint, but we don't fall into a recession. So we're looking, as I said earlier, at an EPS growth rate at the index level between 0 and 5%. Real yields are definitely on their way down. They're currently 1.75%, but let's assume that they are now back on their way down much lower. Then the resulting risk premium at a 21 times 4P multiple is close to around the historical average of 4.5%. So essentially, what we're looking at here is the S&P 500 is basically priced for weak but not a recessionary economy, and for a gradual normalization of real yields to come down from 1.75% much closer to zero, which was where the real yields were pre-pandemic. So that then, of course, that has an implication for equity risk premium, which of course then also declines. So you could easily, argue the bear story, but you still need the outlier of a recession or an acceleration of inflation. At the moment, that's not really what we're seeing. The bullish story also is probably less likely, not impossible again, but the bullish story being no recession, the Fed cuts fast, they're not indicating that at the moment, and that risk premia remain tight. So we're left, somewhere kind of in the middle, which would leave things at the index level in terms of equities essentially at fair value. Now, on the US Treasury bond side, we've actually seen an interesting thing happening with what's known as a bull steepening going on since the beginning of the year. So as you know, yields came down enormously at the end of last year on the basis of the Powell pivot, let's call it. So the market hears the Fed about upcoming cuts, and therefore front-end yields, as in short-term yields, have come down to reflect that. But also, at least on the bond market side, they also see future nominal growth kind of holding up. So not going into recession, not kind of racing away, but just holding up, which means that at the long end, yields stay roughly unchanged. This is since the beginning of the year. So what that means is that you've had front-end yields coming down, long-end yields basically staying relatively constant. So you've got what's known as a bull steepener. Now that would explain the underperformance of cyclical stocks because of the idea that nominal growth is not falling out of this off a cliff, but it is weakening. So under those circumstances, it's perfectly logical for cyclical stocks to be underperforming, at least in relative terms, if the consensus is that GDP growth is indeed weakening. Now, a word of caution here, because although the soft landing viewpoint, this sort of, the Goldilocks scenario of not too hot, not too cold, seems to be definitely in vogue, the recession playbook typically sees anything from 10 to 27 months of persistent yield curve inversion. We're up to 22 months so far, so we're still not even outside of that, very wide range. And then what tends to happen with the recession playbook is that you then get a reversal of the 2-year, 10-year inversion. And that happens, or tends to happen, close to when the labour market is actually turning recessionary. Now, where do we sit now? The curve has still not disinverted. It's still inverted. It's less inverted than it was, but it's still inverted. And the labour market is cool, but it's not turning recessionary at the moment. So it's a good idea to kind of keep that at the back of your mind, that although, we're in this situation where the soft landing view is the central view, it's still not, we're not in unusual territory here with respect to how long these macro lags are taking to play out. So overall, in conclusion, what I put to you is that although US equity markets have rallied and hit new all-time highs since the beginning of the year and carried on from the end of last year, if you take a step back from all the noise and people's, saying that equity markets are overvalued, not much has really changed since the end of 2023. In terms of US real GDP growth, it's still running at a kind of underlying trend of around just sub 2% and gradually slowing down. The labour market is adding approximately 115,000 private sector jobs per month. That goes up and down, which is much slower than it was, but not not down to kind of like an alarming pace at the moment. And on the inflation front, core PCE, which is of course the Fed's target inflation measure, is trending at 2%. So, as we know, rates have been high for some time now. So there are always lags here, and those lags could start affecting economies globally in 2024. The Fed's not stupid. They understand that keeping Fed funds at 5.25% with nominal growth slowing is basically the same as monetary tightening. And so, they probably will be proactively cutting rates in 24. I think that really the more interesting and the most pressing questions are actually when do they start, which if you look at the way the market has moved this year in terms of bonds, it's pushed out to at the end of last year, kind of discounting cuts definitely coming in March and April. I think it looks like that the market is thinking that those cuts have been pushed further out, but still looking for cuts in 2024. And, as I say, the most pressing question is when do they actually start? And most importantly, how fast are they going to go? As we know, markets hate uncertainty. But as long as the direction of travel is in a kind of orderly disinflationary direction with low growth, but not recessionary growth or negative growth, and a proactive Fed cutting rates, that's basically all that matters to deliver a kind of comfortable and predictable outcome and to really, kind of cut the tail risks. And that's essentially, where the markets moved to in the early part of the year. So I think that the bond stroke equity market bearish narrative might be in conclusion on the surface seductive, but actually I think for the time being, given what we're seeing with the economic metrics, it's actually just noise.